These are 5 stocks that our investors are buying now. Today, we're going to analyze and look at the 5 most analyzed stocks inside our Everything Money community by our users in the last 30 days. Stock number 1, Ulta. I own this company. Do not buy a company just because somebody on the internet owns it. Don't buy it just because thousands of people own it. We're here to teach a process that you can learn to apply to companies. But with Ulta, here's the reasons why I own it that makes sense to me. First off, it has surged lately. Why? It was at $3.20 a share as $3.18 a share on August 12th. But it was disclosed that Berkshire Hathaway had bought some shares in it. Here's why I like Ulta. Good margins, limited locations with smart growth, buying back smart shares, and still having same-store sales growth in this kind of retail environment. Now, granted, the last same-store sales growth was very marginal. I think it was 0.1% or 1%, something very small. Wasn't great. But remember, even a declining business has value. The question is, can you pay a good price to make up for that? This is a company with all retail locations, but $19 billion market cap and $22 billion enterprise value. That difference of $3 billion is essentially their debt, and they have free cash flow of $1 billion in the last year, $890 million in the last 5 years on average, and great returns on invested capital. So this company has an ability to pay off its debts very quick. And for retail, it's pretty solid considering all the retail locations they have. They also have a great return on the money that they invest in the business. This has a moat status to it and also says, hey, when they invest money in the business, they get good returns from it. That is the good management of their capital. Let's go look further. Look at the 8 pillars here. 8-pillar thriller. Mostly because of their valuations. Because look, in the last year, they were at 575. Their all-time high was in March, and it's their 52-week high as well. They didn't have check marks here at that point. They would have X's here. But remember, a fast-growing company, unlike Ulta, because Ulta's not growing a ton very fast, can still be a great buy even if there's X's right here. You have to pay a premium for good growth. You pay a premium for high returns on invested capital. All right? So what kind of growth do they think they have? Well, analysts think their earnings per share are going to go from $26 a share to $41 a share in the next 4 or 5 years. That's pretty good growth. That's well into that's pretty much double digits a year. And even revenue growth, 3 to 6% a year for the next 4, 5, 6 years. That's pretty awesome. A lot of that's going to be from new stores, and a lot of that's going to be from same-store sales growth. It's a combination of both. So what's the right price to pay for Ulta? Let's just go look at Stock Analyzer. I'm going to pull it up in my history. Stock Analyzer is an incredibly powerful tool that helps investors evaluate and analyze stocks using key financial metrics, and I use it daily. Its purpose is to simplify the investment process by allowing users to make assumptions about a company's future performance, such as revenue growth, profit margins, free cash flow, and price-to-earnings ratios. It analyzes data based on investors' expectations and desired returns. Now, guys, I'm going to do 2 assumptions on a 10-year analysis. I usually do 3. I'm going to do 2, a low and a high. That's why I'm going to focus in the middle at when we get the numbers. 3 and 7% revenue growth with this great increasing return on invested capital, which I love. Profit margin, I did 9.5 on the low side, 11% on the high side. Same with free cash flow. Even though free cash flow has been lower pretty much all along the way, I'm still okay with keeping these the same. PE, guys, with a high return on invested capital, I think this justifies at least the market PE of 15. The historical PE and price of free cash flow, and I put a high side of 21. And remember, I did my 9% return. I do that now because I want to look at my intrinsic value. What's the value of this company based on a market return of 9 or 10%? But of course, you have to add margin of safety because we're humans and we make mistakes. And guys, the future is unknown. We have no idea what's going to happen in the future. You have to have that margin of safety. So don't take these numbers as the be-all, end-all. I hit the Analyze button. All right, I got a low price of 346, high of 670. As you can tell, at 320, it was an amazing, amazing opportunity based on my assumptions. That's what's important, okay? Now, I did my analysis. I want you to do your analysis. This is the analysis that our users are using in the community. Stock number 2, ATKR, Atkore. I do not own this company. They make a lot of electrical products. 5 years up 173%. Couple things. $3.2 billion market cap, 4.2 enterprise value. That difference is their debt. about $1 billion with $400 million in free cash flow. Now, their free cash flow and 5-year free cash flow is lower than their net income. So the first thing I'm going to advise, find out why. But again, good levels of return on invested capital. 5-year average of 23.5, 1 year of 23.8. So it seems pretty consistent. All right. They pay a dividend. All right. But look at this. Look at this market cap. 8 times free cash flow, 7 times 5-year free cash flow. This is what's attracting our users. Great margins too. 35% gross margin with half of that being net margin. That's pretty incredible. Great growth rate too. But one thing I want to check on the growth rate, I'm going to go to the cash flow statement and see if the growth rate was from acquisitions. A few acquisitions. I mean, it is yearly, but it's not like 300 million is a big one. 40 million, 80 million, 100. This was net sales, 183. So they do have some growth from acquisitions. So you got to remember when you're doing this, when you're analyzing this company, make sure you see how much of this is from acquisitions. You want to focus on their natural growth. Now let's see if there's any analysts. Let's see what the 8 pillars say. Another 8 pillar, not a shock. My guess is there's going to be a lot of 8 pillars here for our users to look at. Buying back a lot of shares. I love this. Single digit free cash flow, buy back those shares, really drive up that EPS and free cash flow per share. Love that. That's incredible. Let's see what analysts think. Basically, marginal growth on EPS and no growth on sales, basically. Very marginal. Now, I did do a 10-year analysis, and I'm going to do one analysis here. I'm going to do 5% growth on revenue, 14% profit margin, 14% free cash flow, 13 PE, and a 9%. Because there's not much growth. I could be wrong on this one. I'm still giving a big premium to today. I hit the analyze button. Wow. Stock's at 86. No wonder people are excited. This shows a really high potential return. Why? Because the stock's so cheap. It's only selling for 5.5 times PE, 8 times free cash flow. If they keep taking their cash flow and buying back shares, if they take 100% of their cash flow, $300 million, $400 million a year, and buy back shares on a $3 billion market cap, this thing will be a huge generator. This is a very interesting position. I'm probably going to go in the community and have conversations with our community members about this. Stock number 3, a little bit bigger, the Googly Moogly, $2 trillion market cap. Guys, incredible company. Could it be a high price of free cash flow of 33, a high PE of 23? Maybe. Their free cash flow was 61 billion versus net income of 88 billion. There's a big difference there, but a growing return on invested capital, 5-year average of 14.5%, 15.7 for the 1 year. Guys, it's a big company. Bigger companies are going to be harder to make outsized returns. Google had fallen to 83, 84, 85 bucks a share just 2 years ago. Great opportunity. People were calling for the head of the CEO. They wanted him fired, all these things. It's much of the same things I hear about Nike now and how they're failed and blah, 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 blah. Is it true or is it news following the stock price? Let's go check out the 8 pillars here. Now, this is a 6 pillar because we have the X's here, but remember what I said earlier. Great company with a lot of growth potential. Could it be justifiable? Because look at their analyst estimates here. Double-digit EPS growth, almost doubling in the next 4 or 5 years. You got to pay a premium for that. I don't care who you are. You got to pay a premium for that. Revenue growth, double digits, 357 billion to 521. A lot of great growth there. But let's do the 1 year, the one assumption on the 10 years, 7.5% revenue growth. Might be conservative. 24% free cash flow and 24% profit margin. 23 times earnings and free cash flow. Great company. Owns the top 2 search engines in the world, Google.com and YouTube.com, and has a phenomenal balance sheet. Tell me what you're going to pay in terms of a multiple for these companies. And 9% return. Hit the analyze button. 180 is my price, according to my assumptions. 10.5% return today. You can see why I love it at lower prices. This is a company I regret not buying at $85, $88 a share because it probably made sense there and I was too much of a wuss. Why? I have no idea. But this is why I created all of this. This is why I created the tools. Remember, we have stories. We have numbers. This is about marrying both of those together. You can get the stories in the community, from the people, from the news, all these things. But the numbers here are where you're going to focus on what's going to drive you what to look at. It's really difficult to invest, not because of the numbers, but because of the emotions. That's why we have the community. It's about keeping your emotions in check. Don't you want to be the kind of person who gets excited over red days? I'll tell you what, in our community, when there's red days, it is more exciting. It is way more exciting in the community. People talk about it all the time. And if you've seen on our website, we are limiting the number of daily spots because we want to keep those great community members growing. We want the people who are going to be excited and who aren't emotionally driven by their decisions. We're going to be better at making good decisions as stocks fall. That's where the big money is made. So if you want to get one of those community spots, click the link in the description below. Go to everythingmoney.com/sign up. We're making these changes soon where we're going to split all these up and you can't get everything. This offer right now gives you all of these tools at one great price. And best yet, you can try it out for $7 in 7 days. That's simple. So guys, if $1 a day is worth changing your entire life, sleeping better at night, probably getting better returns, and being around thousands of like-minded investors, if it's not worth it to you, are you truly a value investor? And if it is worth it to you, low risk, high reward. So click on that, join. We limit the spots, $7 for 7 days. Stock number 4 has fallen tremendously lately. Dollar General. All-time high, 262 back in May of 2022, 168 in the last 1 year was the high. It is currently at $86 a share. 52-week low was just last week at $78 per share. That's a big fall, guys. From April of 2022 to last week, from 260 down to $78 a share. That's a 65%, 70% drop. News follows the stock price. Now, different from Ulta. Around the same market cap, but look at this enterprise value, $42 billion. Lower return on invested capital than Ulta. Big dividend yield, 2.75%. Much lower price to free cash flow and PE than Ulta though, about half of it. Almost half of it. Generates really good free cash flow. The 5-year free cash flow of $1.5 billion is a lot lower than their 5-year net income. That's something to do research on. But so far, I'm liking everything it's doing. 8 pillars. Okay, a lot more X's. That debt level makes sense. Free cash flow is lower. Net income is lower, even though revenue is higher. Okay, one thing I'm going to do here, guys, I want to go to their 10K from our website, directly from our website, to see how many stores they're opening and closing every year. Oh yeah, they opened their first stores in Mexico in 2023. That is awesome. So they're expanding outside the country. So now, I've shown this data before. They have 19,986 stores, almost 20,000, and they're growing about 5% a year, maybe 4% a year. Okay. So that's the that's the growth from opening stores. Well, let's look at some assumptions here. Here's what I'm concerned about. They're growing their stores 4% a year, and their revenue growth is only supposed to be 5.5%, 6%. So the same store sales growth isn't that great. But remember, over time with inflation, they should keep up with inflation on there. So that's something to consider here. But look at their earnings per share growth. $7.71 this year, growing to $12 in the next 5 years. That's pretty good growth. A big drop from last year, though. So let's see what the DG has to say. Now, on this one, I'm going to do the 3 levels. 10-year analysis. Declining ROIC. I do not like that. Not the end of the world, but I don't like that. Revenue growth. I did 3, 5, and 7%. Profit margin. 5.5, 6.25, 7. Free cash flow. It's a lot lower than the profit margin. So I'm already not a big fan of that. And for PE and price of free cash flow, I actually went 13, 15, 17 because I don't like the declining ROIC. I don't like the lower free cash flow. I don't like the fact that their growth is basically driven by opening more stores. I hit the analyze button. But guys, look at this. Big time potential. 110 to 140 on the low side, 210 to 290 on the high side, 150 to 200 in the middle. This is a great lesson I want everybody to understand. Just because a company doesn't look good doesn't mean it couldn't be a good investment. Now, is this a company to hold on forever? I don't know. But there could be a mispricing here that could be taken advantage of. And you have to decide what kind of investor you are. I've changed my type of investing from buying things like this to buying companies that I want to own for a long, long time. Now, the question is stock number 5, an opportunity. Well, guys, the 5th most popular stock to look up in the last 30 days in our software, not a surprise, Nvidia. Nvidia is all over the place. All-time high, 140 back in June. 52-week low was $39 back in October. In the last 10 years, it's up 24,000%. 10 years, not all time. Last 10 years, all time, 286,000%. This is incredible. Great balance sheet, less debt than cash. Great growth. The question you have to ask yourself is this a permanent plateau for the company? Look, their 5-year average free cash flow is $15 billion. Last year was $47 billion. 3x that. You have to ask yourself, is this a permanent plateau for Nvidia? Are they going to keep growing from here? That's the real question here, because everything else is awesome. Everything else is awesome. 180 and 195 times 5-year numbers. But remember, it's grown a lot in the last 5 years. So this is useless to me. I'm not even looking at this stuff. This is the story I'm telling you about when I tell people, look at the story that the 8 pillars tells you. Why is it so high? Well, because they've grown their free cash flow and profit 3x in the last 5 years. You can't look at this. Now, the 1 year price of free cash flow, 62. The 1 year PE, 55. Is that a lot for a $3 trillion company? Feels like it. But if they're going to still grow here from 20, 30% a year, even for 4 or 5 years, this could mean nothing. And let's go see what analysts think about that. Analysts think they're growing their profit essentially 4x in the next 5-6 years. They're growing their revenue 4x in the next 5 years. Guys, this could still be a value play today. Now, the question you have to ask yourself is, are these analyst estimates accurate? Is the juice worth the squeeze? It probably is. But for me, the kind of investor I am, it just makes me uneasy because they got to hit those marks. They got to really crush it in order to do that. And the euphoria of the market has driven Nvidia up so much. And they've made up such a big piece of the S&P 500. The question you have to ask yourself is this sustainable? If it's sustainable and you believe they're going to hit all these metrics, I think you got to take a look at it deeper. It's a very, very riveting story, and the numbers can justify it if they hit these numbers. So let's see what the stock analyzer tool will say. I'm going to do my low and high assumptions in NVIDIA, just 2 of them, for the next 10 years. I'm doing 10% revenue growth and 30% revenue growth. I'm doing 30% margin and 50% margin. Same with free cash flow. PE, I'm doing 20 on the low side, 30 on the high side, and my 9% returns. And I think this is going to be amazing. Now, guys, remember, you want all these tools, click on the link in the description below, join the community, $7 for 7 days. I hit the analyze button, bam, low side of 36, high side of 385. If they do hit those 30% growth return, all those numbers, it is a screaming deal today. So guys, if you want to watch our video on 5 multi-bagger stocks that our community wants, watch this next video. I'll see you in the community.